Welcome to our 11th annual Manufacturing Outlook. And yes, this would be our first annual virtual Outlook. I think we all can agree these are completely uncertain times and unprecedented times, right? But now more than ever is a time that we feel is to lean forward and not lean back. And I think you can look at our title, Moving Beyond Recovery, and you may be thinking, these guys are crazy. This is a time when, COVID cases are going up. Yes, but this is also a time when we're seeing many companies take this and say, you know what? Let's not waste a good crisis. And we've probably heard that before, and it's maybe a little bit cliche, right? But this is really the foundation of our 4-part series. Is really about moving beyond recovery, and it's really the foundation of our manufacturing outlook. When you think about let me get to my next slide. There we go. Our pillars of our manufacturing outlook. One is really around disrupt the status quo. Yes. We're always looking to think differently and bring new ideas to our clients. And like I said, think differently. It's a pillar of our outlooks, and that's what we are really focused on over these next 4-part series. Challenge your organization, right? So we're trying to pull you out of your business a little bit. We want you to think differently. We're not, deep in technical topics. We're really at a very strategic level to help your company to see things differently, challenge your organization, and also most importantly is to provide thought leadership. Is very critical. And these mark really the pillars of our manufacturing outlook that we've been, fundamentally built a very successful following over the last 10 years. So how do we think about moving beyond recovery? And what are some of those key drivers to accelerate growth, right, that we see? And these are not all of them by any means, right? But over our 4-part series, we're going to spend a lot of time around strategy. And we talk about strategy a lot, and everyone has it in their head, and a few people know where they're going. But do we really get strategy on paper? Do we really have a 2, 3, 4, or 5 or 10-year plan? That's what's critical, right? And I know it, we've heard it, but if you open any book, anything, it starts with strategy, and we need to really spend more time putting together a plan. Our part 4 is going to be spending a great deal of time about what we feel is very critical for middle market manufacturers to build sustainable business, is building scale. And you think, gosh, how do I do that? I'm not, I don't have the resources. That's what our team is here to do, is to help guide you and advise you. Is it doing M&A add-on acquisition? It might be selling to a private equity group to build scale, to broaden your reach. Whereas we'll see from a company we'll have on our panel, Alta Equipment, that going public, you think there's no way, and maybe it's not, but it's a way to really accelerate growth. And most importantly is, what is that fundamental? We need that strong balance sheet. So how do we build that? How do we, build a balance sheet that we can attract capital or additional leverage to be able to grow? And we'll talk about that certainly in our part 4 also. And yes, we've spent a lot of time about attracting and retaining talent, and it means something different today, no doubt. Today we're fighting to get our own workers to come back in many cases because of the additional unemployment benefit that's out there. But that too will pass. And, having a critical brand, and you think brand, how do we, even a middle market company needs a strong brand to attract and retain talent. But if there's one thing that I think is most important, and we've spent the last 4 or 5 Manufacturing Outlook really talking about innovation, Industry 4.0, technology, this pandemic has really taught us one thing, is that the future is now. There's no doubt about it that innovation is the key to where it's going to accelerate growth. And you see it in, why you think about why are certain companies able to, take this opportunity, and it's really driven by potentially, a big piece of it is driven in innovation, right? The ability to work through their supply chain through innovation, and we're going to talk about that in our part 3 about supply chain pretty much quite a bit. So there's a lot of ideas, and you think, we talked about making your product smart and connected. We've had a company, Twist Think, that we've worked with that helps company innovate their products. These are all out of the box ideas and strategies really to help you think differently. But let's talk about, these are our 4-part series that are coming up. And today is really about setting the stage. So critical. And we always started off with, what is the economic outlook? And we're excited to have Kevin here from the Federal Reserve, because I am really interested to hear, what is in store for the economy? Where are we going, right? And so this is going to, really, be very, very interesting. And backed by popular demand is definitely Thomas Stewart to really talk about that middle market sentiment. What's keeping people up at night, businesses? What are some of the opportunities? What are some of the threats? So today is really, really an informational day that sets the stage. And if you haven't signed up, part 2 is this Thursday, and very exciting. Thomas Stewart's going to lead that and moderate that panel. It's going to be a mixed bag of really moving beyond recovery, talking about reshoring, some IP risks, some talent. So it's got a little bit of everything in it. We have a client that'll be on the panel also. And in part 3, it will be our UHY advisory team, really talking about supply chain. Lots of this is the biggest area right now is supply chain and speed to market. But we're going to hear some interesting thoughts around the Biden, if a Biden election, what does that mean for supply chain? And a Trump, what does that mean for supply chain? So really some objective views on, what's going to happen. And finally, our part 4 next Thursday is really around financial strategies to take sustainability to the next level. We've talked about a little bit about building scale. And we have a private equity group on the panel. We have a commercial lender. We have Alta Equipment. And myself, I'll be on there to talk a little bit about some of the risks and some of the opportunities with the election coming up. So, and also real quick, what's coming up is our middle market survey. Will be coming out very soon. I did get a little insight. I was, one question on there was around, where you see that your biggest investments coming. Equipment is still number 1. We've been doing our innovation and technology presentations, our outlook for the last 4 years. Got to get that up a little bit higher. I think it's going to be critical that we invest more in really some of this intangible and for innovation and technology as we move forward. So, but really, I want to get this session kicked off. Very excited to have everybody on board. Again, I'm Thomas Alongi, the manufacturing leader. I'll be on each of the intro for the next 4 parts, the next 3 parts. But really want to turn it over to Kevin. Kevin comes from joins us from the Federal Reserve. He is a business economist and banking officer, the research division. in the Bank of St. Louis. He joined the bank in 1988. He holds an MA in economics from the Colorado State University. So I'm going to switch this over to Kevin and have him turn over. Kevin, you should be, it should be your screen.
Okay. Let me get situated here, Tom. All right. Well, thank you very much, Tom, and thank you to you and UHY for inviting me to speak to you today. So I'm going to kind of talk a little bit about where we think the U.S. economy is headed over the near term, and also talk a little bit about sort of some key longer term risks and maybe opportunities that I see for the U.S. economy. As usual, you know, anytime you hear a Fed speaker, they always give a disclaimer side. So these views are not necessarily those of the Federal Reserve Bank of St. Louis or the Board of Governors of the Federal Reserve System. Okay, so I'm going to, if you're not familiar with FRED, Federal Reserve, or FRED is it's an acronym for Federal Reserve Economic Data, but it's more than Federal Reserve data. FRED is the nation's largest, I think it's the world's largest, actually, world's largest free database. It's housed here at the St. Louis Fed. So if you're not familiar with FRED, shoot me an email and I can direct you to our FRED team and they can get you going. So I'm going to use a few FRED charts in my presentation. So when I give talks, and you know, I give a fair amount of talks on the economy. That's basically what I do. I'm a forecaster for the bank president and the staff economists here at St. Louis Fed. So I always start my talks by you know, sort of giving a big picture overview. I think you can learn a lot about the economy or anything in general by just asking one simple question. And that question is, what is going on here? So the big picture is kind of meant to sort of provide a narrative or a set of answers to that question. So from the big picture standpoint or 30,000 foot view, you know, the pandemic really put the kibosh on what was the longest U.S. economic expansion on record. The economy was actually strengthening coming out of 2019 and into early 2020. So without the pandemic, I think we would be seeing pretty solid growth right now. The recession was clearly the deepest on record. I use that past tense. I think there are signs, pretty good signs that the recession is over. It was the deepest, but probably also the shortest. But you know, we see through a glass darkly. There's a lot of uncertainty, and so we should be a little bit careful in how we think about that going forward. Just, you know, stunning job losses. It's interesting. The labor market is interesting in the sense that it's pretty unusual compared with any other recession. Most of the workers who went to the unemployment lines are what are being classified as those on temporary layoffs, and we're seeing a lot of those workers being called back to their jobs. Obviously, with the economy just collapsing at a unprecedented pace, policymakers couldn't stand by and just do nothing. So the Fed, as well as Congress and the administration, responded aggressively. The CARES Act was passed, which is about 2.6 trillion. Embedded within the CARES Act was a little over 450 billion for 5 new Federal Reserve lending facilities. So obviously the trade-off there is a very large budget deficit, and the nation's debt to GDP is now basically the same size as total GDP, so about 100%. The pandemic produced much lower inflation rates, which is generally stimulative on net for the economy, and also lower interest rates. Obviously, interest rates have embedded within them an inflation premium. So when inflation falls and inflation expectations come down, that obviously, all else equal, tends to lower interest rates as well. And then finally, financial stresses really spiked in March, late March into early April, and they've since come back down to normal. So financial market conditions appear to be okay at this point. So I think to kind of level set everything, what I'll do here is this chart is basically trying to provide some context for the state of the economy as reflected in the economic conditions, the fallout from COVID-19. That's the red dash line there. So I'm comparing, so what I'm doing is I'm benchmarking real per capita GDP. So I'm benchmarking it for these 4 episodes in the year of the crisis. So I'm looking at the Great Depression, the Spanish flu in 1918 to 1923, and then the Great Recession and financial crisis from 2007 to 2009. So I'm looking at sort of at the beginning of the crisis, that's year 0, and then 5 years after the crisis, so we can kind of see where we are. So the COVID-19 pandemic, the hit to real per capita GDP, we don't have all of 2020 data yet, but as best we can tell, the hit will probably be around 8% compared to 2019, and that's in the neighborhood of the Great Depression. After the first year, real per capita GDP declined about 10%. So that's where the parallels kind of end. The Great Depression continued to last for about 4 years, and it's at its nadir, at its bottom. The decline in real per capita GDP was about 30%. So you compare that with the Great Recession and the Spanish flu, the Depression was just in a league of its own. Now, as best we can tell, based on forecasts anyway, real per capita income or real per capita GDP is expected to increase next year. That would be year 2. So it's probably a little bit steeper recovery at this point than the Great Recession in 2007, 2012, and the Spanish flu. So, but I think the bottom line here is just like the recession and Great Recession and financial crisis, 2007, 2008, 2009, it's probably going to take a while before we get back to the levels that we saw in 2019. Okay, so here's manufacturing production. Everybody's familiar with this series, I'm sure. It's part of the Federal Reserve's industrial production series. As everybody also is probably all too familiar, manufacturing is kind of unique. It's very responsive to overall economic conditions. So in that sense, what we say, it's cyclical in nature. It responds very actively to both good times and bad times. And we see during recessions where manufacturing production falls, and generally falls by much more than the overall economy. So in this crisis, COVID, the peak to trough decline, which occurred over 2 months, was about 16.5%. It was not quite as deep as the global financial crisis. That decline was a little over 17%, but you can see that the length of the decline, the duration of the financial crisis, was considerably longer, whereas this time around it was basically a short and very sharp decline and subsequent turnaround. But again, compared with the Depression, it's nowhere near the decline we saw in the 1930s that lasted basically 3 years, and manufacturing production declined by over 50%. Okay, so I'm going to go through kind of a what I call an economic narrative in several parts. So, the U.S. and global economies seem to be climbing out of a deep hole. We're seeing rising output employment, and you saw that in the previous chart with manufacturing production. Um, I think we're into this point in the recovery where business expansion dynamics are currently in place. So we have this sort of near-term cyclical strength, and typically what happens during a recession, particularly in the manufacturing sphere, um, is that you have a decline in orders. So firms are meeting the lower level of orders through inventories generally. They're cutting back on production. So when the recovery gets going, inventories are lean, and therefore firms are ramping up production to meet both new orders and to restock existing inventories. So this has been called the bullwhip effect in economics, and I think we're sort of in that state of play right now. But then over the longer run, you have this natural tendency for the economy to grow at a pace that's determined by fundamentals. And I'll talk a little bit about that in a little bit. But there's several unknowns. Obviously, you see another spike in COVID infection rates and fatalities. At this point, infection rates, case rates are going up again, but fatality rates generally are not growing up to anywhere near the degree that we saw early on this year. So that's, I think, heartening in one sense. I think another round of widespread sort of blanket lockdowns would be extraordinarily damaging. So one of the things we're seeing in Europe, for example, which is seeing some second wave as well in many countries, is they're bringing lockdowns back, but they're more targeted because they learned from the previous lockdowns that you just can't. It's just wildly inefficient to lock down everything. You need to be more targeted in your approach on how you address this issue. So hopefully that will be the case this time around if we go in that direction. Here's employment. Again, in March and April, a combined 22 million jobs were lost, a little over 22 million. We've seen some recovery since then. From June to September, about a little more than half the jobs were recouped. So again, we've still got a little over around 11 million to go. It's probably going to be a while before we get back to the peak we saw in February 2020. Here's the unemployment rate. Again, a very, very, very large spike. Peaked a little under 15%. It's come back down. It's now under 8%. The thing that's kind of interesting, at least from an economic perspective, is kind of the unique aspect of the pandemic labor market. Obviously, part of the CARES Act was providing some temporary relief for firms and workers to sort of get through this big shock. One of the ways firms did that is they furloughed employees, but told them, look, once things settle down, we're going to call you back. So a lot of the, in fact, almost, well, not quite all of them, but a very large percentage of the workers were called as viewed themselves as on temporary unemployment. And that's the black line there at the bottom. You can see in a normal recession, the unemployment rate ticks up, which is the blue line, almost solely because of you have what's called these layoffs that are not viewed as temporary, which you might think of as permanent. So this time around, we've seen a little bit of a spike in those sort of permanent or semi-permanent unemployment rates, but by far the largest increase in the unemployment rate this time around was driven by people who are on temporary furlough, and that's starting to come back down sharply, and that really reflects what we saw in the previous chart with the big decline in unemployment as these people are beginning to be called back from, to their jobs. Um, Another big unknown is whether there's going to be sizable long-run supply effects. You know, Economists call that economic scarring. Um, eh, the pandemic really had a very large effect on the services sector, and that's probably not too surprising. The services-based industries depend a lot on human interaction. You can think of lodging, tourism, air transportation, so on and so forth, retail and restaurants. So, when there's not a comfort level for individuals to travel, to go out to eat, and obviously those industries in the service sector are going to suffer a lot, and that's what we've seen. There's also the case that there's still many people who are not back at work, so you have this um, unused capital stock, basically office buildings, uh, essentially being unused to a large degree at this point. So this again very inefficient from an economic standpoint. So the question going forward is how much of a shift in these preferences is going to be permanent, and how much of it is will end up being temporary. I think as we think sort of longer run, obviously there's been technologies developed during this pandemic, and we think of Zoom and some of the other technologies that we all use today. And is that going to lead to sort of longer run compositional changes in output and employment? Is it going to affect business travel, for example? If there's fewer people working in buildings in a city center or other um, area where you have a lot of workers, you tend to have other things like restaurants, Starbucks, and other things. So obviously that has the potential to affect these other retailers around those areas. And then finally, as Tom mentioned, there's a lot of commentary now, certainly in the economic sphere and also among manufacturing, about how a supply chain might look going forward. I've already seen stories about how some firms are beginning to rethink the just-in-time inventory system. So that's in play as well. So here's to just to put a bow on it. Here's the composition of consumer spending. This is the largest part of GDP. Again, I'm benchmarking it in January for everything, so you can kind of see where at any point in time you're going to see what the percentage change is from the January level. So you saw big declines in durables and services in April, and that pulled down the total, which is the blue dash line. But spending on durables like automobiles, appliances, consumer durables, furniture, for example, has really come roaring back, and now it's actually well above the pre-pandemic levels, as you see there for the last data points for the black and red lines. What's really holding consumer spending back, it's not back to where it was at the peak in January, is because of services spending. So spending on services, which is a large part of the consumer spending bundle, is still down by about 8% from its peak. So clearly we need people to begin to go out and do a lot of the things they did before the pandemic, but again, while there's still uncertainty about the path of the virus and things like that, you're just not seeing a comfort level for many people to go out and do that. Here's kind of a chart showing the scarring we're seeing, the bankruptcies, number of large retailers filing for bankruptcy thus far in 2020, at a record high, at least for the data we have available going back to 2005. One good positive development is that we're seeing a large number of applications for businesses. So as an economist, Tom talked about innovation. So this is, I think, a good example of innovation and entrepreneurship. And you can see that these business applications really got going right after the shelter-in-place order began and people began to lose their jobs. So a lot of people apparently decided they're going to take measures in their own hands. They're going to do something maybe that they wanted to do for a long period of time, or or perhaps it was because of necessity. They went out and began to um, form their own company or business, and um, and uh, and I think this is sort of a healthy dynamic of capitalism that we like to see. Okay, so you know, I've always liked this quote by Ed Leamer. He's a professor at UCLA. Human beings, we like to tell stories. We like to when we think about the future, or even what's going on currently, we like to look at patterns, and then we take these patterns and we tell stories about them. That's certainly what economists do, and like myself, we're in the forecasting business. So when we think about the recovery, as I mentioned earlier, the economy is going to grow at a rate consistent with its fundamentals. So those fundamentals basically are, how many people are working, business capital spending, and discovery of new ideas, innovations, things like that. That's sort of really important for rising living standards over a long period of time. So currently the economy is operating well below potential, chiefly because of the first two factors. The number of people working is not back to where it was before the pandemic, and business capital spending, and business investment rates are very weak. So economic stimulus, whether from the Fed or from Congress and the administration, is designed to boost the growth and demand for services, and that therefore increases employment and investment by firms. So that's kind of the rationale for how policymakers respond in a crisis situation. So in view of some of the uncertainties about the shape and path of recovery, the question is now paramount, certainly in financial markets anyways, is more fiscal support necessary? Some Fed officials certainly believe that to be the case. In the Fed parlance, we call that managing downside risks. So Chair Powell, Vice Chair Clarida, and some other Federal Reserve presidents and governors have been saying that, to really cement the recovery and to give it the best chance of going forward, they believe that, we need to basically spend more money. Congress and the president needs to allocate more fiscal support. However, there's other Fed officials who argue that the amount of fiscal and monetary stimulus has been appropriate for the size of the shock. And thus, we've put in place basically 2.6 trillion. And so we need to allow for these expansion dynamics and the effects of the fiscal support to play out. For their part, private forecasters expect only a modest drag on future growth if no fiscal support occurs. So, obviously you can see some benefits from additional fiscal support. So I think it's a debatable proposition how large that will be. Obviously, it depends on sort of the composition of the plan and the size of the plan as well. Let me turn to sort of longer run issues, and I'll turn it over to Tom. I think there's a couple other dynamics at work, and one is kind of the fiscal consequences of a couple of developments. One is obviously we're increasing government expenditures at a time when the baby boomers are retiring and demographic driven outlays, thinking of outlays stemming for Social Security and Medicare and Medicaid are really beginning to drive the longer term budget dynamics more than anything. And the second thing is this use of what's called monetary financing. So as budgets become tight, there's a risk that Congress will begin to force the Fed basically to finance a lot of the projects that maybe not that may not get through Congress. So I think the first order effects of these two things is certainly higher debt to GDP over the longer run, and a potential second order effect is higher inflation. Now, just in terms of the fiscal side, here's a chart basically showing fiscal support or stimulus acts for COVID, the 2008 recovery, the 1933 New Deal. That's in the left chart, obviously in dollar terms. COVID is more than double the 2008 recovery, and basically quadruple the New Deal, but if you benchmark it in terms of the size of the recovery, clearly the Great Depression again stands out dramatically, where the size of the stimulus was almost 3/4 of the size of GDP, whereas this time it's about 15%. Now, a big part of the stimulus was going to support income, and what we saw this time around is real after-tax income actually rose sharply during the recession. You can see that point there at the very end. And this stemmed from a couple things. One is obviously there was a very large expansion in unemployment insurance benefits, and also a very large expansion in SNAP benefits, basically food-related benefits for poor individuals or those who lost their jobs. And that caused real after-tax income to spike tremendously during the recession, which is, again, very unusual. A lot of discussion about the path of unemployment insurance benefits going forward. They're certainly beginning to wind down compared to the peak in June, but certainly it's still on net, still well above what we saw in April. Okay, so obviously the first order effect of all the spending is rising debt levels, and this is a chart from the Congressional Budget Office. So the longer term debt projections out to 2050 have publicly held debt. Again, that's debt excluding the so-called Social Security, Medicare trust funds, about 200% of GDP. I've done some work. Former colleague and I did some work in the past on the accuracy of these long-run budget projections, and not surprisingly, these long-run debt deficit and debt projections are not very accurate. So we need to, I think we have the sign right. The question is whether we have the magnitude right, whether the magnitude is being understated or overstated. The second dynamic at play is sort of the Fed's new strategy that it unveiled in late March by Chair Powell. Basically what the Fed said is that we're going to sort of change how we do monetary policy in a couple key dimensions. One is we're going to place a little bit more importance on employment. So if the unemployment rate is low and the economy is running hot, the Fed is not necessarily going to be preemptively raising interest rates. So this is the idea of running a hot labor market as long as inflation remains low. And then the second key thing they said is that because inflation has been running well below the 2% inflation target that the Fed put in place in 2012, that it's going to seek to temporarily drive inflation above 2% to make up for past misses. So this is, I've called this a high wire act, this strategy. There's a lot of unknowns about this strategy, not the least of which is people generally don't like higher inflation. So, so this is going to be interesting to see how it plays out. But also the question is, can the Fed actually drive inflation higher? The Bank of Japan, which is basically taking the kitchen sink approach to try to drive inflation higher to meet their inflation target, essentially has not succeeded. So I think the bottom line is that if you think about sort of the fiscal impulses and the monetary policy changes, this suggests that maybe the long run inflation outlook may be a little bit less sanguine than many expect. So here's the Fed's balance sheet on the liability side. Again, we're back up to around $7 trillion. Again, if you look at where it was back in 2008, again, basically a sevenfold increase in the size of the Fed's balance sheet. The bulk of that is currency and what's called bank reserves. So these are basically cash deposits by banks at the Fed. So this is the kind of what Milton Friedman would call high-powered money. used to finance lending. So there's a lot of stimulus right there if things really begin to turn around. So this is sort of the risk to a higher inflation that some people talk about. And this is the Fed's projections. This is the projections of the Federal Open Market Committee from September, and basically they're saying that, look, we think where we are now, the Fed's interest rate target is going to be basically at zero for the next 3 years. So again, we'll sort of see how that plays out. Conditions can change, and they make these projections every quarter. So I think the message that's being conveyed now is that given where we are in the state of the recovery and the expansion, we're more in the recovery phase than the expansion phase, that the Fed is going to provide the juice necessary to keep the recovery going so that the expansion can really get going. And despite all the the impulses for higher inflation, if you look at what I call the bond market's inflation barometer, that's the yield on 30-year treasuries, again, basically at record low levels. So I think financial markets certainly have no fear at this point of higher inflation in the future. So let me just finish up with the outlook and a couple charts. I think, as everybody has talked about, and Tom talked about it in his remarks, there's a lot of uncertainty out there right now. Obviously, you've got the path of the virus, you've got future fiscal policy, and and depending on who's elected and the composition of Congress and how that might change, you have this notion of economic scarring and sort of how that's going to play out over time and the degree to which it occurs. And then you have sort of uncertainty about the global economic outlook. And this chart is a measure of economic uncertainty, and it's designed so that it's indexed so that the index value of 100 is normal. So you can see that in the early stage of the pandemic, it rose to about 560. So again, well beyond anything we've ever seen. So uncertainty is very high, and that tends not to be good for firms because firms like things to be very certain in terms of estimating rates of return on capital that they may put in place, or how many people to hire. So when uncertainty is high, firms tend to pull back and sort of wait for the clouds to dissipate, so to speak, before they begin really hiring and investing to the degree that they typically do. So if you look at the outlook from the Fed's perspective, again, this year, GDP will probably decline around 3.5%, 3 to 3.5%. What I believe next year will be pretty solid growth, about 4%, then 3% in 2022. Longer run, the Fed sees about 2% growth. For the unemployment rate, again, steady declines in the unemployment rate, still slightly above what the estimate of the longer run employment rate of 4.1% is at the end of 2022. And then finally, inflation slowly getting back to the Fed's target. Okay, so if you have any need to see any resources that we put together, whether that's data, that's analysis, or report that's COVID related, please visit our website and you can find a lot there. Okay, I think I'm going to give it over to Tom.
Thank you. Yeah, thank you so much, Kevin. Insightful. And I apologize, one thing I failed to mention is on your toolbar on your right-hand side, there is a questions. If you open that up, you can submit questions through there, and we will answer those after Thomas Stewart finishes his presentation. And so we can answer any questions that you may have. I apologize, I forgot to mention that. So Thomas, obviously, he's the executive director at the National Center for Middle Market. He is a senior academic, publishing, marketing executive, author, editor, publisher, management expert with an international reputation for creating, developing, promoting important business and leadership thinking. Thomas can do it all. We're excited to have him here. And I'm sure his presentation will be very exciting. So thank you, Thomas, for joining us, and I'll turn it over to you.
Tom, thank you. And let me make sure that we're actually showing the screen, and that should be there. It's great to be here. Yep. It's great to be here again. And I had the pleasure of talking to this forum live in Detroit a year ago, and I'm glad to be back here virtually and talking to you. Let me tell you a little bit, first of all, set a little bit of context. Having come after Kevin, you know, one of the things that they say is don't fight the Fed. And so I'm certainly not going to disagree with anything he said, but there's some nuances when you look at some of the detailed things in the manufacturing sector that you might want to find instructive as you sort of move down from the macroeconomic view to the sector view. And then, of course, in your own lives, you'll be thinking the microeconomic view about your company, your firm, the decisions that you want to make. I also want to pick up on a couple of themes that you'll hear as we go through that Kevin also enunciated. First of all, this importance of detailed information. Second of all, this word uncertainty. You'll see it in the slides and the conversation, the presentation I'm going to make with you toward the end when we talk a little bit about uncertainty. But uncertainty for an economist, which I'm not, but Kevin is, has a very special meaning. It was defined by John Maynard Keynes, or described by the great John Maynard Keynes, as something in contrast with risk. Risk is something where you can calculate the odds. There's a 20% chance of, a 47% chance of, it's 50-50, whatever it might be, there's a risk. Uncertainty, as Keynes said, is something where you just don't know. We just don't know. And uncertainty is different from risk in the sense that it's incalculable. And for those of us in the business world, uncertainty is a complicating thing, because if you just don't know, but you still have to put together a budget, if you just don't know, but you still have to make a decision about this investment or that investment, if you just don't know, but you still have to run a business, you're sort of acting in a world of uncertainty. And so you want to think about sort of an approach to uncertainty in which you want to make bets, but you want to make bets that are sort of recoverable. You don't necessarily want to make mega bets that you can't step back from. You sort of want to make bets that you can sort of advance a little bit at a time and not necessarily put everything down on, you know, on red, or put everything down on number 13. You actually want to sort of come in a little bit at a time. My stockbroker said something about a stock I was interested in. He said, why don't you nibble at it a little bit? So uncertainty changes your investment profile. The other thing is we'll talk a couple of other themes that he talked about was this question about job changes and job losses and whether they're temporary or permanent. We may see, it'll be interesting to see whether these furloughs bring people back to work, which they will in some places, or become permanent layoffs, which they will in some other places. And you saw that chart. It's sort of hard to tell how those two lines are going to go over time. And of course, the progress of, or progress is the word, the next course of what's going on with the pandemic itself will have a lot to say about that. So let me tell you a little bit about what I'm going to talk to you about, which is sort of now what? I mean, when we looked at this, and I'll tell you a little bit about the research that we've done, when we started looking at the impact of COVID on the middle market in March, and it was like, you know, a car had suddenly crashed off the road, and executives were saying, oh my God, you know, is the engine on fire? Is anybody hurt? That sort of first shock of impact. We went back and we talked again in June, and it was a little bit more like, okay, we're alive, now what? What are our next steps, and how do we find our way getting out of here? The headlines are that, first of all, the US middle market has taken a beating from COVID-19, as the economy has broadly. Revenue, employment turned negative, confidence shattered, investments cut and postponed. Manufacturing has shared substantially better than the middle market as a whole. I think that's largely because so many manufacturers were considered essential businesses. Unlike retail and wholesale and airline travel and a bunch of the services that Kevin was talking about, yes, some manufacturers shut down, but for the large part, manufacturing continued as after a break construction did. And so those two industries perhaps faced less disruption than others. Recovery doesn't look to be as quick from the data that we're seeing as perhaps the data that Kevin is seeing. And there may again be a microeconomic, macroeconomic difference. The aggregate effect of recovery may be faster than the effect on individual companies. And one of the things we also saw is that re-engaging employees and customers is the key to getting the key in the ignition for that sort of recovery. Now, the quick commercial about us, and then I'll get into some of the detail. We are part of the Ohio State University's Fisher College of Business. We're a collaboration between Ohio State and Chubb. And our purpose, we are basically the nation's only research center focused on middle market companies. When you think, what is the middle market? How do you define the middle market? When the center was founded about 9 years ago, we went and took census data and sort of said, where do you set the sliders to find the middle third of the private sector, the GDP? Lots of other businesses define it different ways. Private equity firms and some investment banks tend to define the middle market in terms of EBITDA. Commercial banks often in terms of, what's the address, where in the bank it fits, in the bank structure it fits to be economically profitably served. But we sort of went to that data and said, what's the middle third? And that gives you a spread of a big spread between 10 million of companies with annual revenues between 10 million and $1 billion a year. It's 2 orders of magnitude, but they're bigger than small and they're smaller than big. There are about 200,000 of them. They're almost all private. 85% of them are privately held. They represent a third of the private sector in terms of GDP and jobs. And until the last 6 months, they have been the growth plate, the lion's share of economic growth, and 60% of new job creation. We'll see also that these companies with annual revenues totaling $10 trillion occupy a very interesting sweet spot. They occupy a sweet spot between resilience and runway. They have the resilience, the ability to take a licking and keep on ticking, but also the runway for growth. And smaller businesses tend to have the runway, but not the resilience. Multi-billion-dollar companies tend to have the resilience, but not the runway. Much a higher percentage of their growth is inorganic than in the middle market. But in the middle, you get that sweet spot. And coming out of the Great Recession 10 years ago, we saw the middle market far and away leading the US economy through that long expansion. Whether we'll see that in the recovery and progress from COVID and the associated recession is to be determined. A little bit about impact. First, I want to talk about impact, and then I want to talk about recovery and some capabilities that seem to give companies a stronger platform for recovery. We went out, as I mentioned, in March, right after the World Health Organization declared the COVID-19 to be a global pandemic. We took a quick pulse check then, talking to companies we'd also talked to in December. We went again in June and did a full middle market indicator survey of 1,000 companies with about 287 of the manufacturers, I think, 159 manufacturers, sorry. And we did our full middle market indicator survey. We were able to reprise some of the COVID questions that we asked in March. We also asked some questions about PPP and some of the other recovery programs, which I won't go into in this presentation. And we're going to share the data I'm going to share. It comes from that, plus some deeper analysis of some of the data. Let's start with the headline, which is how bad it was. And these are data from June. So this is companies, asking companies in June. And you remember where we were. The Northeast had taken it on the chin, was starting to recover. The South and the West, the South and through Texas were starting to grow, but that had not really become severe. That became severe in late June and July. We hadn't seen what we're seeing now is this third, I won't call it a third wave, but this third burst in the Midwest that we're seeing right now. But that's where we were. And at that point, in the whole middle market, 13% of companies, which is 1 out of 8, said that the pandemic would have a catastrophic impact on their business. Now that was good news, because in March, 25% said that it would be catastrophic. So that's that falling off the cliff and are we dead yet? To that, oh, we're not dead, now what, sort of change from 25 to 13%. But take a look at the manufacturing numbers. Only 5% of manufacturers predicted that COVID-19 would prove catastrophic for their business over the next 6 months of a period in the middle of which we find ourselves now. So that was the overall view that people saw. Here's what happened to revenue growth. This is year-on-year revenue growth. So these are companies asking them in June, compared to your revenue June a year ago, what's your revenue like now? So you realize that those companies that had 7 or 8 months probably of positive revenue growth before February, when the storm clouds suddenly emerged, and then they had 4 months of negative growth. And what you see is that for the middle market as a whole, year-on-year revenue growth plunged 3.7%, and that was after the first part of the year where revenue growth was going at about a 5% top line growth rate, maybe a little more than that. I can't remember off the top of my head. Manufacturers' revenue growth fell a lot less. It fell only 2.3%, and the companies in the S&P 500 had their revenue growth fall a lot more. Not sure what the explanation for that might be, but one might be that those tend to have much more exposure to Europe than middle market companies have, and much more exposure to the global economy generally. And so they might have seen a bigger and earlier hit to revenue than the US middle market, which is more domestically oriented. Here's a bit of an industry panorama, which sort of shows you, and Kevin alluded to some of this stuff too, it shows you where the damage was. And let's not look at the forecast for the next 12 months. I'll get to that later on in this presentation. But on that first column on revenue growth, and you see manufacturing down the 2.3% I mentioned before. Across the way, you see construction actually up a little less than 1%. Financial services, not so bad, but wholesale, retail, other, and healthcare really having very significant declines in revenue growth. The healthcare story is kind of interesting because your intuition might be that healthcare would actually have some pretty good top line numbers, but everything moved over to COVID. A lot of discretionary things, doctor's visits, dentist visits, plastic surgery, all kinds of other things that bring in a lot of revenue and also more profits for some of the healthcare industry were put on hold. And healthcare is actually facing maybe the most significant disruption of any of the industries and the overall impact of COVID. Here's the employment picture, and I've got a shorter timeline, a shorter time horizon on here, but you can just sort of see it. Again, you see the bright red line is the US middle market as a whole. Below it, the blue and gray lines are small business and large business, and you can see in the first few quarters here that story that I was telling you about, how the middle market is where the job growth is. And you actually see that manufacturing's employment growth was growing, was a little bit above that of the middle market as a whole from the fourth quarter of 2018 up to the fourth quarter of 2019. And then they both fell, but again, manufacturing fell less badly than the middle market as a whole. It only fell 1.3%. Again, not as many manufacturers were shut down. More of them were considered essential industries. And as we'll see going forward too, a number of manufacturers found themselves in places where business picked up right away, depending on what they were doing, or some of them pivoted into new products and maybe new value-added services that drove their revenue substantially higher. There are a number of winners in this sea of losers. There are quite a number of winners, particularly as we'll see among manufacturers. Again, here's the employment by industry picture, and take a look at wholesale and retail, 11.6% and 5.5% down. I should caution that wholesale trade number is a relatively small number of companies, so 11.6 is not as reliable a number as some of those others, but You all know it. You saw it. You know, the closed stores, the closed shops, the closed hotels, the closed things that would show up in retail at a really substantial drop in employment. Every bartender's out of work or was out of work, and many of them temporary, but some of them permanent, as we'll see going forward. Another piece of impact was the impact on economic confidence. This is a number that says, you know, are you confident, very confident, extremely confident, somewhat you know, are you in any degree of confidence? So they're like on a 5-point scale. It's the top 3 boxes on a 5-point scale. How confident are you in the economy? And one of the patterns you see here is that mid-sized companies, which tend to be local champions, are most confident in the local economy. It's the devil they know, right? It's the streets they're familiar with walking down. Next in the national economy, and least confident in the global economy. And you can see in that global economy line, starting in 2018, the effects of tariffs and trade wars knocking down global confidence. What's interesting to me on these data is that the the national and global numbers are down sort of where we saw them in 2012, 2013. But the local confidence actually hit a record low. And we'll be going out in December and we'll get new numbers and we'll see whether, you know, to the degree to which confidence has picked back up. But you all know that confidence is something on the basis of which you make decisions. And you make decisions about where to invest, whether to hire, so on and so forth, looking not only at what's right in front of you, but what you expect in the months ahead. One of the things that people did immediately when the pandemic started is they pushed the pause button on investments. And you can just sort of see this here, that in December, more than half planned to enter a new domestic market. By June, that had dropped to 4 out of 10. A quarter expected to build a new plant or facility. In June, that number had dropped almost in half, and 14% said that they planned to build a new plant or facility in the next 12 months. And that's that picture of, I don't want to make big irretrievable bets until I can see what's going on. Now, we also saw that companies said, one of the things I'm going to do is I'm going to put a lot of money in my pocket and I'm going to keep it there. This is a question we ask. If you had an extra $1, where would you put it? Would you save it? Would you put it aside as cash, or would you put it to work? And if so, where? There are 2 cash numbers. One is what I call the cushion, the save it as cash, and the other is the war chest, save it as investments. And you basically see that between December and June, people said, 50%, 48% of companies said, if I had an extra $1, I'd put it right in my wallet. And 2/3 of them said, and I'd put it right in my wallet and save it as cash as a rainy day fund. Now, manufacturing's picture is a little different, and it's partly because of that purple or lavender part of this of the pie, which is capital expenditure. I mean, manufacturing is an capital intensive industry. And you notice not too much change in that, what you would do if you had an extra $1. Now, that's not a real extra $1. That's the revenue fairy giving you, if you had an extra $1, what would you do with it? But the capital expending piece of the manufacturer's wish list has pretty much stayed the same, but the cash cushion numbers have grown substantially, as you see, substantially in terms of saving it as cash, but saving it in a war chest down a little bit. So manufacturers held cash, reduced IT spending by a significant amount, but are holding the line or want to hold the line on CapEx. Now, this has been a long recovery, I mean, a long expansion, the longest in US economic history. But in the last 2 years, we had seen in these data sort of emerging signs that the recovery was a little bit long in, or expansion was getting long in the tooth. This is the trend between the first quarter of 2018 to the second quarter of 2020 for the percentage of companies that would hold cash, hold an extra $1 as cash, war chest or rainy day fund. And you can see it sort of gradually rose. And here is the CapEx spending And you can see, first of all, you can see the big difference between manufacturing and the rest and the middle market as a whole in terms of capital intensity. But you can also see a slowly declining CapEx line, both across manufacturing and the middle market. Basically, I think as people felt this recovery is going on and it's slow, it's still growth. It was still growth before the pandemic hit, but it was growth at a slower rate, and people were dialing back a little bit and holding on. We saw investment appetites begin to wane. This is a bit of an eye chart, but it's taking a look at what we saw before the pandemic hit. And you see going from left to right, you see those add a new plant or facility, introduce a new product or service, enter a new domestic market. You see those lines sort of trending down a little bit. They fell down dramatically when you look at what's happening with the COVID-19 impact. Again, you see add a new plant or facility. This is for the total middle market, cutting almost in half from what it was a year before. A little bit less on new products and services, less entry into new domestic markets, international markets, and a drop in acquisitions. Manufacturing, it holds up, and you see that innovation spike, the introducing a new product or service actually has accelerated in the manufacturing sector over the last periods that we've been looking at, and that part of that may be that pivot as companies come up with new products in response to what we're seeing from COVID. So what are we looking at? Growth forecasts are muted. Here's the revenue forecast for the middle market as a whole. Last 12 months, down 2.3%, and up for manufacturers. Their forecast is for the next 12 months is of growth at 2.9%. Employment, you see a bit of a recovery for manufacturers, going from a negative 1.3 to a positive 3.0, while in the middle market as a whole, you see a little bit of a forecast continued to decline, but basically flat employment level. So you see some employment growth in manufacturing. You also see some very interesting differences. There are winners and losers, as I mentioned. Look at this. Look at what you can see here in terms of some of the winners. Take a look at that 2Q20 bucket. You can see that in the middle market as a whole, in the last 12 months, 1 out of 5 companies actually had a revenue increase of more than 20%, more than 10%. Now, that's half of what it was, or that's 2/3 of what it was in the previous quarters, but still pretty substantial. And 42% had actually negative growth, so a 2-to-1 ratio of positive to negative growth. Over among the manufacturers, however, you see 3 out of 10 actually had more than 10% revenue growth, and it's a 4-to-3 ratio in terms of companies that actually lost revenue to companies that gained revenue. So there are some really strong winners in there. And if you take a look at this chart, I'm going to go through it pretty quickly, but you take a look at where people have pulled back and where there have been positive or negative impacts in various functions. You can see that, that negative impact on revenue. You can see the big negative impact on supply chain. But you see on the bottom on digital transformation, what you see is that actually there's very little difference between the negative and positive impacts on digital transformation. If anything, there's a slight increase in digital transformation activities by middle market companies. For manufacturers, you see 2 things. First of all, the biggest negative impact is not on revenue, but on supply chain. And you probably all know that from your personal experience. It was a holy mess with a negative impact on supply chain, and to some extent continues to be. Down there in the digital transformation area, you see a slightly stronger positive impact as manufacturers have started to make changes, not just in what's going on the factory floor with automation and more digital twins and all that good stuff, but also in some of the other aspects, digitizing the supply chain and digitizing payments and so on and so forth. So a pretty positive impact on digital transformation for manufacturers. One of the things we also found, this is kind of interesting, is we found a half a dozen capabilities that were strongly associated with a superior ability to resist COVID. We might call them an immune system. And what you take a look at here is we look at every quarter we ask, or during our middle market indicator, we ask companies to grade themselves from A, B, C, D, or F on a number of attributes. And these are 6. where companies that said that they gave themselves an A or a B, an excellent or a very good rating on these attributes, had a much less dreadful impact from the pandemic than others. One of them was being able to access capital at an affordable cost. A 20-point difference between the companies that had an A or a B and the companies that gave themselves a C, D, or an F in the impact of COVID. Those with an A or a B, were 63% of them said they had a low impact from COVID versus 43 for the others. Being able to withstand a downturn in your industry, in other words, strength in your industry, very important. Marketing and communications capability was more important than sales capability. It says to me that knowing your customers and being able to talk with them and stay in touch with them, really important. Having a plan. Tom Alongi talked earlier about talking in the fourth session about planning. Well, planning is a really great immune shot to have. Keeping talented employees and having a plan, a program where you're investing sufficiently for the future, not just in a sporadic way, but on a sort of a regular cadence of investment. Those immunity capabilities are also capabilities that seem to support a more robust recovery. Remember, the middle market as a whole expects a growth rate from June to June of 2% in revenue and a slight decrease in employment from June to June of 0.2%. We'll take a look on the right and see where these companies that with these capabilities find themselves. They find themselves saying that they would have growth rates 3 times, in the case of access to capital, 3 times the middle market as a whole, and infinitely number of times of increased in employment growth. Being able to withstand a downturn, again, a 5 to 2 increase, difference in the projected growth rate. So these capabilities, there's some others we can go into in more detail, and if you have some questions about it, I can answer them separately. But these sort of 6, call them magic capabilities, are capabilities that really have allowed companies to withstand the storm better than they otherwise might have. Of course, this is across the whole middle market. This is not just those companies that were in sweet spots where they were already making PPE. This is with the middle market as a whole. These things really matter. So what's the key to recovery? We asked what the most difficult management challenge is. Ongoing uncertainty, that theme I mentioned at the beginning and that Kevin mentioned, that's number 1. And the number 2 and 3 tied are customer relationships and employee communications and relationships. Getting your customers back, getting your people back, getting your customers to feel safe, getting your employees to feel safe, and getting them engaged. Now, about 80% of middle market companies say that they expect to make significant and long-lasting changes in how they organize the workplace and how they interact with customers. The numbers are a little lower for manufacturing because the customer is less likely to be directly in front of you the way he or she is at a retailer. They're a little lower on the customer side, but they're basically pretty much the same. They're not, the differences are not very significant. There are going to be significant changes in your workplace, significant changes in the ways you interact with customers, and they're going to be permanent. And those are some of those innovations that Kevin spoke of that may be innovations that we capture and keep, which might be Zoom rooms, might be that digital transformation of your supply chain, of your payments, of your shop floor. So they will be significant. How long is it going to take? Well, in March, people thought that this was going to be a light switch. 40% of companies said that once this thing's under control, we can be back to full capacity within a month. And 19% said it would take 6 months or 7 months or more. Those numbers flipped 3 months later. And the number of companies that said that they'd be able to get right back to work, like 23%, and 40% said that it would take 7 months to more than a year. So people are seeing a longer road ahead. And of course, this question asks, once the pandemic comes under control, which we all know it is not quite. Here are the numbers for manufacturing. It's interesting that get back to work quickly number is significantly higher for manufacturing, and that's probably because so many of you never closed shop, and we're continue to work, so it's a little bit easier to bring people back and get back to full capacity, whatever that may be. Just a thought to leave you with. Many of you know this framework. It's one that I've seen from time to time, and it's just something you might think about the 5 M's of management: our money, our methods, our machinery, our materials, and our people. But back in the days when it was the 5 M's, it was manpower. And you might just ask yourself some questions about, is it impaired? Our access to capital, our methods, our machinery, our materials, our manpower, is it impaired? Is it worth fixing? Can it be improved? And can it be not just improved, but can it be, that's that second column, sort of optimized? Can it be improved, but can it be transformed? And as you're thinking about how you're going to get this car out of the ditch that it's in and move it forward, you might want to ask that question. Is it broken? Is it worth fixing? Can it be improved? Or should we do something radically different and get out of there on some sort of a jetpack or some sort of radical transformation? So that's the story. Let me pass it back to Tom Alongi, and we'll close it up and go over to questions. Tom?
Sorry, I am muted. Let me just get the screen fixed here. Well, thank you so much for a very insightful presentation, Thomas. And one thing I will say, I'm excited that we were certainly aligned on our immune system, because it's kind of the foundation of our 4-part series.
I saw that. I thought, not bad, right?
Yeah. Yeah, we're pretty close, and that's what we're really working with clients to build that. I never thought of it as an immune system. We thought of it as sustainability, but I like your word there. So we're very much aligned on that. We do have a couple questions. Kevin, if you can you share your thoughts on what impact on GDP do you think will be with a Biden versus Trump win?
I've been in the Fed for 32 years, and typically, I don't know how many election cycles that is. I guess that's 8, maybe 8 divided by 4. 32 divided by 4 is 8. So yeah. So typically, what we do is, people throw out proposals, but really we don't begin thinking about the effects on GDP until the legislation is actually passed. Now, obviously, from a broad perspective, both the Trump administration and Senator Biden, Vice President Biden, has proposed significant increases in spending, and I guess Senator Biden has proposed maybe more of a shift in higher taxes. So, obviously, higher taxes, regardless of review from an economic standpoint, tend to be depressing on economic activity. So there's going to be a trade-off there between increased spending and increased taxes. So at this point, it's really hard to say how the effect is going to be on GDP until it actually becomes law. Again, there's uncertainty about who's actually going to win as well. So I hate to punt on the issue, but that's the best answer. Tom talked about uncertainty and risk, and sometimes the best answer is we don't know.
Yeah, no doubt about it. We hear a lot of different viewpoints on that, and I think either way, no matter what election we've been through, we're resilient. Manufacturing is resilient. We find a way, and we'll continue to find a way under whoever wins. And we do like the low tax environment. We certainly, I think we can agree on that. One other one, what is the risk of no new fiscal stimulus through January, assuming COVID risk rises with their further targeted lockdowns and service sector deterioration?
Yeah,
Probably
I think, is that for me, Tom?
Yeah, probably be for you. Yep.
Okay. Well, again, as I mentioned in my comments, I think, if you have another sort of blanket lockdown, that would be, I think, really bad for the economy. The blanket lockdown last time around, drove the unemployment rate from a 50-year low to, the highest since basically the 30s. So, we're already at about 8%. So another lockdown would probably drive that even higher in the second round. So I think policymakers have kind of learned that you need to be a little bit more targeted and maybe use other methods. And in terms of the stimulus, my view is that, as I said in my presentation, you'll have a little bit weaker growth in the fourth quarter and maybe into the first quarter, but it's nowhere near to cause us to drive us back to negative growth. That's my view.
One of the things what Kevin was talking about, targeted, is important, because if you're going to be targeted, you have to know where to shoot. And one of the big challenges is whether we know where to shoot. Governor Cuomo in New York has basically said we've got enough information that we can aim at specific neighborhoods and zip codes, and we can whack them all very specifically. But we've also seen that, in the Dakotas and other stuff coming out of what might have come out of the Sturgis rally, nobody knows. So it's so that's one of the big challenges, I think, is if you want to avoid general lockdowns, you got to be able to have more a more pixelated or fine view of where problems are, so that you can avoid the general and sort of go after hotspots.
Yeah, I think what economists would tell you, at least a lot of the economists I follow, is that you need to have a really aggressive testing protocol, where you can, and other countries have done this. The question becomes, how do we do that here in the U.S.? But identifying people that have the virus so they can self-quarantine and remove themselves, I think would be.
And identifying neighborhoods, specific neighborhoods, zip codes, and whatever. Yeah.
Yeah, I think the positive thing is hopefully we are turning, corner as far as, there's a vaccine in sight. It'll take some time, but it's good to see that the death rate is declining overall.
Can I just add something, Tom, on the vaccines?
Yeah.
So one of the stories I've been telling in my forecasts is that a vaccine would be a game changer for 2021, 2022.
We agree.
But I'm looking at the polling numbers, and smaller and smaller percentages of people said they would take the vaccine. So that's kind of, you have to factor that in as well.
Yeah,
I agree. The vaccine's a game changer.
Yeah.
The vaccine's a game changer. I think, you start opening up, restaurant, hospitality, airline. People are going to flock to vacations and make up for all that lost time, but it's probably going to take a little bit of time for that to all come into play. Thomas, I get one other question here is, from your research, what has been kind of most surprising, fact that you've, found about, kind of middle market manufacturers is, they're.
Yeah, I'm not sure it necessarily shows up in the data per se, although it does show up in that percentage of companies, that 3 out of 10 that's had a 10% increase. But I think one of the things that has been surprising and encouraging is the number of manufacturers in the middle market who have really shown an ability to turn on a dime and get new products and move their facilities. I was talking to a guy in Philadelphia, plastics, a molded plastics company. Within weeks they were making plastic things for swabs and stuff like this, and companies that have pivoted to make masks and other kinds of PPE. So I think some of that is true and exciting. And in other areas you've seen too some of this stuff about in some of the service sectors where the Paneras of this world have said, well, people aren't coming to Panera, but maybe we can bring Panera to them. So the amount of I think the unleashing of innovation has been, I guess I shouldn't say it's surprising, but it is always surprising. It's kind of good to see and say, oh, that was clever. It was really,
Suddenly it's the future.
Yeah. To see how people.
Your menus, your OCR rater from your menu, all kinds of different, I think it's exciting. We've seen that with, a lot of clients we've been working with, and, being pivot, I think is exactly right. Is one of the number one things we've seen, those companies that are well positioned. Like you say, have a strong balance sheet, have the ability to, take risks, have done very well. We have seen some companies that just accelerate growth. They have just accelerated through this, and that's really kind of is the foundation of these next 3 parts is to really talk about some of that. Time to. It feels like you want to lean back a little bit, but let's work through that uncertainty and try to lean forward. I think we're almost right on time. I think we were planning to finish at 2 o'clock. So with that, I think, let me just make sure I think those were the main questions. I think I got all of them. A lot has changed from the second to the third quarter. Any updates on third quarter? I know you were working on that, and
the next wave goes out. The next wave goes out first 2 weeks in December. So we'll get the numbers back. They'll come down the chimney.
Yep. And I think you can visit your website, correct, Thomas, for that information?
Yeah. And the St. Louis Fed also has tons of great charts. It always has. So yeah, both those websites are worth.
Yep. I think we all have some great data, and our not our manufacturing, but our middle market surveys will be up shortly also. And so, well, thank you everyone for joining us today. We look forward to, hopefully you can join us for part 2. Thomas is going to be leading and moderating that session. And so that's just that's on Thursday. So we look forward to having everybody join us. There'll be a little shorter session, I believe. So again, thank you. And we will be sending out a follow-up email with the presentations, so you'll have those. All right. I think we're good. Thank you so much.
Thanks, Tom. Thank you, Thomas.
Thank you all. Thank you, Tom. Kevin.